been born in America, particularly from certain racial groups, we'll say, then you are well aware that credit scores have absolutely wreaked havoc on your economic capacity, yourself, your family. So many negative effects have come from credit scores over generations that have restrained families and households and whole communities to poverty, essentially. So now that the media is coming out with all these different changes that are going on and these apparent signals that credit scores are becoming obsolete, there's more and more content creators covering it. A lot of us are starting to get anxious at the idea that finally one of the biggest barriers to prosperity for many groups in America may be going away. This live stream is dedicated to clearing the air on that with the most recent information and to give you some backdrop as to where this is really headed when it comes to underwriting, credit scores, etc. To get it out of the way, credit scores are absolutely not going anywhere. I just want to get that clear right now out of the gate, save you some time. Credit scores are not going anywhere. But what is changing is how overall risk assessment is being conducted. And that's what's important. We're going to be talking about that more in this live stream. So basically, what's been going on lately is credit scores have seemingly been, the requirements have been dropped in certain places. You're seeing certain places completely scrap it, depending on, the FHFA with the Federal Housing Administration with the current Trump administration. They've been kind of putting out media about scrapping credit scores. What you have going on is a scenario where, credit scores have been used to do risk management and to expedite the activity in commerce, right? So my ability to be able to do business with you as a stranger and do so at the lowest risk possible with the highest probability of whatever we're agreeing upon, whatever we're trading, whatever payment we're setting up, whatever the case may be, I got something to pull that gives me an indicator of the level of risk you might provide and how reliable you're going to be at paying me back. Hopefully that makes sense so far. So that's the general overview of how credit scores have functioned in the economic system. What we're dealing with right now is a scenario where credit scores have been a tool to determine the level of risk private entities want to take. So when the economy is in a certain position, they may decide that they want to loosen requirements and they want to allow for more business. They want to grow their books. They want to engage or lend out more, whatever the case may be. They want a broader clientele. They want to reach a certain market. When the economic circumstances have shifted in a different direction, they may decide to use credit scores as a tool to deny and push out as many people as possible, minimize their risk, and lock in as much as they possibly can. Yo, what's going on, Elijah? Welcome in. So y'all make sure y'all leave a like as y'all coming in the building. So what you have going on right now is a scenario where the economic landscape is shifting and credit scores right now are being viewed as a barrier, right, for economic activity. The housing market is to a crawl. Lending has tightened tremendously. Debt levels are through the roof. So people's credit scores are dropping, like nationwide credit scores are dropping amongst all demographics, generally speaking. So you have a scenario right now where credit scores are almost working against the system in a sense of speaking. The economic system, the powers that be in the system, they're looking to kick up the economic activity. They're looking to increase activity in the housing market. They're looking to cover more ground faster with economic activity. They're looking to drum up and pick up economic activity. So credit scores right now are being used against them because at the current standards that have been set for banks, lenders, even insurance companies use credit scores. Wherever you can think credit scores are being used, whatever parameters they have in place for their current risk management, which is dated off of a previous economic cycle, that is now in the way because that barrier is too damn high for what's going on in the real marketplace and the real economic system, if that makes sense. So Elijah was asking, what are we talking about? We're talking about the media hype around credit scores looking like they're going away and more entities scrapping the use of credit scores or lowering credit score requirements. Why is this happening? And the real clarity behind what's going on and how you can maneuver around the current changes that are going on to get access to the financial system and build up your prosperity. Hopefully that makes sense for you. So what we're dealing with right now is the system is kind of rolling over on itself in a sense of speaking. So they're adjusting around this, right? You've seen the Trump administration get rid of the FICO monopoly when it comes to mortgages by allowing Vantage to come in with their credit scoring models, which Vantage has been documented to be a bit more lenient and broader, all-encompassing of more data to come up with its credit scores than FICO has traditionally been known for. So basically a softer but still effective way to assess more people for mortgages. Same thing's going on with the, I believe it's the FHFA or something like that, but basically the federal agency around housing that does their assessment for mortgages that they're gonna back. And so they've kind of like, it's come out in the media that they're dropping credit score requirements or like scrapping it all together. There's several other signs and different, laws being passed and executive orders that have really pushed against credit scores being used at all, or they've ultimately been used or ultimately been shifted to be lowered. And they're looking to open a door to more economic activity. And if you also pay attention to what's going on, the Federal Reserve is being pressured to lower rates, not only from the Trump administration, but they're also being pressured to lower rates from the economic data and circumstances. Rates have been higher than they've been in over 20 years. So what this basically means is that borrowing costs have been higher, and all of this has slowed down economic activity. So if you're looking to pick up economic activity, then what you're looking to do is make borrowing easier to do, cheaper to do, and have more money flow in the system and have more consumers and businesses eligible to get access to that capital. That's what picks up economic activity. So if you think about that, that means that makes sense why credit scores would ultimately be a barrier to that. And that's where we are currently right now. That's why you're seeing so many changes from the government administrations. You're seeing private companies starting to do things differently, banks doing things differently. The next layer to that is technology and financial technology, data analytics technology has all picked up tremendously in the last handful of years. As we all know, we hear about it all the damn time. We're constantly hearing about the advent and the expansion and the growth of technology and AI, etc. What's happening with that is a part two to this is now it's a scenario where a lot of these banks, lenders, insurance companies, everybody who's using credit scores on a regular basis to do business have more and more access to data and have a smaller or a lesser reliance on credit scores to assess their clientele or to assess their market that they're looking to do business with. So that's changing the ball game as well. On top of the economic and political pressures that are pushing against credit scores, you have a scenario now where companies, banks, institutions, especially ones of decent size, they have access to the technology at scale to assess a lot of things in-house that they used to have to outsource to FICO, Vantage, etc. So now banks, decent sized banks, larger banks, lenders, mortgages, you name it, they have the technology and the data to access banking data. They can get payroll data now. They can get all these different forms of data that can better broadly assess your ability to repay, where credit scores have historically fallen short. So that's a game changer in itself as well. What you have going on in that scenario is, it's like, damn, okay, I want to do more business. I want to grow my business. And in order to do that, I need to be effective at assessing the risks that I'm going to be taking going out in the marketplace and doing more business. Very simply put, now I have more tools available to get reliable assessment of risk data, risk analysis, risk management. And I can still turn around at the same time and get that information, do more business off of that information or that data without having to pay for and wait for a third party in the middle to provide that data and to charge me for that data. So like that's all credit score companies and credit score companies like FICO and Vantage are doing. They've stepped in the past and solved a problem in the marketplace back then when they were originated and for decades after, between companies and the end user of the whatever that company was providing. So basically now technology has made these individual companies more self-sufficient in their ability to assess risk. Yes, credit scores are still relevant. They're still pulling it. It's still part of the underwriting process, a part of the due diligence process. But there's so many other data points now that are available, and more companies now have access to it. And it's enabling and empowering them to do business on their own terms more. And so that's the part two of why credit scores look like they're fading in the background or being used less, or they're being, the circumstances are shifting around the demand for credit scores, et cetera. The way we've seen it for decades, where credit scores is where, all of this lived and died. You have a scenario now where it's like, credit scores are kind of in a way of economic activity. We need more economic activity, and credit scores are being used to obstruct that development or that growth in the current economic, cycle we're in. And then on the back end of that, more companies are like, well, I don't really need to rely as heavily on credit scores to assess if I want to do business with a client or do business with a customer. I have other data that I have in-house that I can pull to give clarity on this, or to at least complement the credit scores way better. It used to be, when we were coming through, most of us that are 30 plus, we'll call it, having an 800 was like, that was it. Like, you walk into a car dealership, you apply for a home, like you had, it was presented as if there was no other barrier of entry left. Credit scores were that dominant in the underwriting process, to the point where it was like, the hell I need, you know what I mean? Like, once I got an 800 credit score, I don't need cash anymore. Like, I don't need shit. I'm good. I'm gonna walk off the lot with whatever I want. I'm gonna get whatever house I want, whatever I'm looking to attain, I can get with this credit score. That's changing. That's changing. Now, an 800 credit score is still great, but now you need the banking relationship. Now you need the cash flow. Now you need the proof of revenue. Now these companies have the ability, individually and autonomously almost, or through other third-party options that are more affordable and accessible, to assess you outside of just how you paid your bills in the past. They have current markers they can use that will give them better risk management or complement the existing risk management of credit scores. Hopefully this is making a little bit of sense for more of you that are catching this. Credit scores are not going away, but what is happening is more and more companies, and even the government, is looking for ways to get around the barriers that credit scores are creating, and the fact that credit scores haven't evolved enough to account for all the other data points that can assess whether somebody's safe to do business with, which leads to more economic activity, which more economic activity leads to the asset prices going up. It leads to tax revenue increase for the government. Like, there's motivation for this across so many spectrums. All right. Like, so you got to understand, credit scores account for trillions upon trillions of dollars of economic activity in our economy. Like, how much money in mortgages a year do you think get done? That's credit score based. How much in auto loans do you think gets done? How many billions or trillions in auto loans? How much gets done? That's credit score based. Credit cards are $1 trillion industry. That's all credit score based and has been credit score based. So when credit scores are in the way because the standards or the data isn't keeping up, or it's not evolving enough to include more people or a broader market of people, that's slowing down economic activity, right? So now that's less tax revenue for state, local, federal government. That's less profits for companies. That's less growth for small businesses, less development for community. It snowballs across the entire economy. The entire economy. Nothing is missed. When credit scores are in the way, or any mechanism is in the way around economic activity, it hits everything. And so now we're in an economic cycle. We have a current administration. We have, the private sector. Everybody's leaning in, trying to figure out, how do we get the economy jump started again? How do we get economic activity increased again, and do so without taking any additional or unnecessary level of risk? And part of that is getting away from or relying less on credit scores, but they're not going away, but they're being complemented. It's no longer 50, 75, 80% of the underwriting portion is just how your credit score and credit report is. Maybe it's getting reduced to half of that or some percentage of that. What that basically means is they're finding ways to make sure that credit scores aren't hindering economic activity, whether that's having more credit scoring companies come in, whether that's lowering the requirements or scrapping the requirements for credit scores, or if it's private companies or even federal agencies, the ability that they have to do their own underwriting without needing to rely on credit scores and still come out with decent risk management models. So credit scores aren't going anywhere per se in the near future, but it's evolving how important they are and how much the system is relying on them. So I want you to comment down below. Let me know, like in the chat, looks like some of y'all were confused, but for those of you who catch the replay, let me know down below, how often you've been denied for, what your economic or financial situation has been like, based on your credit score circumstances. Have you done the work and been in a great position and been knowledgeable? You have great credit and it's opened a bunch of doors for you? Or comment down below and let me know, has credit, have you been able to connect credit to the poverty around you or the economic or financial hardship around you? Let me know in the comment section down below the impact credit scores have had on you in your life, down in the comment section down below. I also want you to like, comment, share, subscribe, support the channel so the channel can continue to support you. For those of you who are catching this content that are new, I'm a banker by trade. I'm a retail banker, a business banker. I have a FINRA investment license, mortgage originator's license, life insurance license. I've been in the banking space, for over 13, going on 13 years now, over 13 years now. So you're getting this from a financial professional. It's not just some random dude talking on YouTube. But at the end of the day, I just want to give some context for those of you who are new. To all my pioneers, welcome back. To my new viewers, welcome in. I already know y'all gonna stay rock solid, support the channel, and comment down below as always. And it's always a gift to have y'all come in. But y'all let me know down in the comment section down below. If credit scores went away, they're not. But if they went away, do you think the economic system would be better? Do you think the playing field would be more balanced? Let me know what you think down below, because this is a big topic. We're talking about millions and millions of people for generations have been suppressed by credit scores, essentially, by that form of risk management. Essentially, that form of assessment has truly impacted generations of people all over the country and their ability to build wealth, because they couldn't access capital. They couldn't access the regular financial resources that other people have been able to, who have good credit scores or have the knowledge and insights in managing credit scores. So comment down below and let me know what end of the spectrum you've been on with that, because it's truly an impactful story. Let me know what you think the future of credit scores are going to be, how that's going to shift with technology and financial technology. Comment down below and let me know all of your thoughts. Other than that, I appreciate every single one of y'all. I want each of you to stay focused, stay in motion. I'll see y'all soon.